Hello and welcome to the Baby Giants Investing Podcast. Join us as we chat about the weird and wild world of small cap investing, all while searching for the precious few fast-growing businesses that have a shot at becoming industry giants. This podcast is for entertainment purposes only and is strictly not intended as financial advice. Any opinions are general in nature and do not take into account your personal circumstances, needs, or objectives. Securities mentioned are for illustration purposes only, and this podcast should not influence investment decisions. You should read the relevant PDS and consider speaking to a financial advisor before making investment decisions. Past performance is no indicator of future returns. Podcast guests and their clients may hold positions in the securities discussed in this podcast. All right, we're live. We've got a few lively topics to chat through today. We'll cover some news with Dubber. I don't know. I think something might have happened there. Dual CEOs, do they ever work? We've got a couple of companies. We've got some mailbag questions. Maybe kick off with some good news. Andrew, you had some good news, I think, that you shared in the chat before.
Well, yeah, depending on your perspective. And
good news from my perspective. That's why I like that.
Yeah. So Amazon is going nuclear to power all its data centers. And or not, or maybe I'm over egging the pudding there, but they're considering it as a component.
Well, okay, you've gone like extreme into like extreme watered down. Wasn't it they're building? Is it not actually happening? They're building like was it 900 and something megawatt nuclear facility, or are they just considering it for an idea for it?
I think it's pretty late stage in terms of being green lit. I'm not that close. I skim headlines, Matt. Come on, you don't come to me for details. I'm a big picture guy. But there's signal in it. There's signal in it. The fact that it is something that needs to be put on the table, and I think it's the obvious. Well, there's two big forces at play here. One is just the ongoing exponential demand for data centers. But AI just kicks that into a whole new realm. Like it is so much more computationally demanding, and everyone is racing towards that, right? So it's sort of, I can see it at a certain scale actually making a huge amount of economic sense. And it's interesting too in terms of what that might signal in terms of society's acceptance. And is this a pivotal moment that sort of helps normalize this as a technology? So, and the fact that it's being done by a tech giant, I don't know. It's noteworthy.
Yeah, there's another chart. I can't remember if I shared it with you guys. I normally share these things, but it was looking at I don't think I did. It was UAE's nuclear power generation coming online and how it had been planned for ages doing nothing and then shooting up, and how it's now bigger than all of Denmark's wind and solar combined, which has been going for years, or all of Portugal's wind and solar. This kind of shows how nuclear can step up. It does take a while to develop, but once you get it, it just delivers these massive, they're talking about, it's almost a gigawatt plant, what Amazon's doing there. That's like a city-sized plant. That's huge.
Yeah.
Steady, reliable power. And I guess very low, land footprint as well. So I think that's the biggest draw card for it.
Yeah. And the other thing just to point out before, it's easy to have knee-jerk reactions to this kind of stuff, but the technology has evolved quite a lot. So it's amazing in 2024 you sort of use the term nuclear, and it's sort of Chernobyl's the easy go-to. And obviously I don't want to sort of downplay the risks that are there, but it is worth remembering that things have evolved a long way, and it's a very different proposition to perhaps than what it once was.
They didn't even have a blast cone on top of Chernobyl. They didn't even have the most basic. It was Chernobyl, man. It was Soviet Russia. They sent people in with shovels. It was anyway, we don't need to get into that. Yeah, I think it's good. I think that could be a path for more.
I don't know. I think taking a few pot shots at Soviet Russia is not a bad thing. I think we've really lost our way as a civilized segment of the world once we stopped making movies with Russians as the bad guys.
I like it. All right, so I had some other good news come through. A powerful new anti-venom raises hopes for a universal solution to lethal snake bites, which I thought was kind of cool. And a breakthrough new allergy drug injection protects against severe food reactions. So another medical one. And an ALS patient has a brain implant that translates his thoughts to computer commands. We kind of touched on something similar last week with Neuralink, but yeah, some cool stuff happening, I think.
Very cool.
Very cool. All right, let's jump into maybe we'll start off with a listener question, because that kind of sets up for some other topics that we want to chat about. So Matt on Twitter wrote through, "Hey guys, long-time listener of the pod, wanted your thoughts on the depth of quality small cap companies on the ASX. It seems like quality companies like Altium, Para, Nearmap are getting taken out, and all that will be left is banks, miners, and basket cases like Pointera and Dubber. This is Matt's words. Total ASX listings have shrunk by 5% in the past 12 months. I feel like Oz startups will head overseas like Atlassian or remain private like Canva. Thanks.
Yeah, it's a good
What do you guys
question.
think?
Go, Claude.
Yeah, so we had Gen X as well the other day, yesterday, that received a takeover offer, I think like 27 and a bit cents. And that's so annoying for me because like I really was waiting I basically wanted to buy Gen X for like roughly net asset value. And I was and it sort of did get close to that a few times. But in the end, I was just a little bit too greedy. And what I was waiting for was either for them to go cash flow positive or for them to get cheap enough that I felt like there was a margin of safety worth buying there. And what's happened with Gen X is having received a lot of subsidized loans from the Australian government now, just before it sort of scales up and it's supposed to, according to its forecast, like in the next couple of years, turn cash flow positive, it's potentially going to get taken over. So like all the risk phase of it has been shouldered by stock market investors and the Australian government. And then just as it sort of gets ultimately de-risked, or just before that, an overseas corporation is going to take it over and then, reap the spoils or whatever of what otherwise would have been a pretty decent utility-like option on the ASX. So I think actually the question is, there's a degree of correctness to it in the sense that we do end up losing sometimes a lot of the best options from they don't end up on the ASX. And I think that it would be a no-brainer for Australian society to have in place incentives for companies like Atlassian to, at the very least, be dual listed. So like ResMed, for example, and Cochlear are dual listed. So they're part of our indexes, but they're also... Is Cochlear? Anyway, ResMed is.
No, I don't think Cochlear is.
Yeah, sorry, I take that back. It's not Cochlear, but ResMed is. And I think that, that's probably a structure that works reasonably well for those big companies that want overseas market access as well. However, having said that, the one thing that probably does keep some stuff listed in Australia is that there isn't actually that much decent quality, like good quality companies in Australia. And, a lot of the indexes, banks and miners, which are sort of okay if you buy them at the right price. But there's not that many long-term, multi-year, multi-bagger compounder options on the ASX. And that means that those companies that do end up having that kind of business quality often can fetch quite high valuations. So yes, Altium's been taken over, but it was being taken over for a pretty good price. Like you wouldn't say that Altium has been, down and out and then has, there's been an opportunistic takeover there. It's done really well. And somebody wants to take it over because they see essentially like an oligopoly in a certain niche becoming even more concentrated, and probably then the economics for all the players improve a little bit. So there's a strategic angle there. I'd put Altium in a sort of separate category than Gen X that I would think of as more as an opportunistic takeover. I think we've also recently seen a lot of takeovers in the worse end of the ASX, which are more like opportunistic. So that'd be companies like Whisper, not a very good company, but got very cheap. And so that creates an opportunity for a takeover, I guess. And yeah, like ultimately, I think that, the main thing what we should be doing is trying not to lose the likes of Canva and Atlassian and stuff to overseas. And I don't, we can't force people to list on Australia, but I think, what we could do to make the ASX better quality is actually try to be a little bit tighter and more strongly disincentivize companies like Dubber existing on the ASX for so long, because they are also the beneficiaries of a lack of good options and people buy shares in them. And I think that is a bit of a bigger problem. So I don't know, like I keen to hear what you guys think, and we can delve into Dubber and sort of how you can spot the traps. Like I'm not saying you can always spot the traps, but I guess you've got to think of it as there are some traps that are, companies masquerading as if they're a good company or a decent company or have potential that are just really obvious. And then there are others that aren't obvious. And of course you can get caught in them. I would actually say, Dubber, for example, is much more obviously a trap than Pointera was, even though they both had some sort of red flags. Just the pure amount of red flags for Dubber is a lot higher than Pointera.
Yeah, well, just on terms of the question, there is a very big competitive advantage that Wall Street has over the ASX and will always have, is just the depth of the capital markets. So there's not much we can do on that front. I would argue if you really want a lot of capital and you've got the ability to raise that, that's going to be your first choice. It just is. 100% agree with you though, Claude. We do not do enough to incentivize and support industry here, and that's more of a political discussion, and how you do that's a very sort of deep rabbit hole that you can go down, but we don't do it. That's I think the US's superpower really at the end of the day is they are so geared around entrepreneurship and allowing failure in the system much better than we do. If you start a business in Australia and you don't go, well, you only get, unless you're someone with extreme means, you only get one or two shots at that.
But I also, just on that point, Andrew, I also think we at the ASX allow to be listed and to be hyped up and to be promoted a lot of detritus that wouldn't be allowed on the NASDAQ. Like the standards to get in the door are higher. And that's good because it means more of the capital that's going into a NASDAQ company is available for the real companies. Whereas in Australia, you have this huge proliferation of just complete and utter rubbish that then sucks up some of the capital, and our capital markets, our brokers and stuff, they don't do a good job gatekeeping it. Like they'll
we have a terrible, the regulatory, I mean, the regulators are weak. They don't have much power, and the financial apparatus around all of this, there's a lot of snouts in the trough here. That's very little to do with long-term value creation for mum and dad investors.
The SEC is way tougher for, like, if there's a company on the NASDAQ, they've got a lot more barriers and hurdles they have to jump over compared to like some company like Dubber that is like literally has, just so much wrong with it.
I'll push back a little bit on that, only in the sense that things always look more obvious in hindsight. I don't have Dubber shares. I've never had Dubber shares. We've tried repeatedly to get an interview with them, and there was a few red flags around that, by the way, as well. But WiseTech, just to pick a random example that came to mind, I think, in fact, there was a very well-published short report not that long ago. Not a terrible short report, really. It had seeming merit. It's a hard business to sort of wrap your head around, given the scale of it and how it's sort of grown with all the acquisitions and whatnot. But that's another example that I think a reasonable person could have said, this is obvious to trade us to, in terms of up and to the right, very promotional, et cetera, et cetera. And yet it's worked out well, so far at least worked out well. So it's
let me zoom in on that, because I think that's what I've prepared, right? Is some of the signs that Dubber was particularly iffy. And this is how you would like differentiate it from WiseTech. So the first way you would differentiate it from WiseTech or other companies, that may have their negatives, most companies do, but Dubber stood out, I think, to a lot of us. I'm pretty sure I remember talking with you guys about this years ago, with their extremely low gross margins. So if we go back and look just at the last 4 years from now, the gross margins, so just, this isn't like profit margins, this is just the revenue minus the direct costs of serving that revenue, were about 30% in 2020, and then about 50% in 2021, and then about 30% in 2022, and then about 50% in 2023 again. So over those 4 years, the actual numbers were 32, 49, 30, and 54. Over those 4 years, the average was around 40% of a gross margin. Now, if you think you're buying a software as a service company that has any kind of competitive advantage whatsoever, and it's getting 40% gross margins on average over 4 years, you're either not an experienced investor at all, like this is probably like the first time, or you're not even trying, because there's no possible way a software company that's making money selling some value-adding software is getting margins that low. And then that leads me to the second problem, is their go-to-market was also through the big telcos, right? So in some ways, they're sort of similar-ish to Whisper, which has a similar thing, but Whisper's gross margins were significantly higher despite also reselling connectivity. Okay. So even Whisper, which resold connectivity, had, I think, closer to 60 or even 70% gross margins. So at least there's like a significant chunk of like value they're adding for themselves there. Now, putting aside for a second the low gross margins that Dubber had, the other thing, which is like your classic sign, is we actually had, before the most recent bad news for Dubber, which, they don't know how, if they can access $26 million that they're supposed to be able to access. But the secondary thing there is that they just, if you look at the dilution chart, it's just up and to the right for 10 years.
Yeah, it's massive.
It's just constant dilution. Like, there was never an opportunity missed to dilute. Even when they weren't doing capital raisings, they were giving away shares as part of remuneration. Like, it was always going up. Like the main, there was a huge there was a huge capital raising kind of exercise going on. And that's, again, like, yes, I guess like it would be kind of similar-ish to WiseTech, but the difference is that, if you plotted WiseTech's dilution with its revenue growth, you can sort of see like, yeah, okay, there's some dilution, but also revenue growth. Whereas Dubba's dilution is just, even more incredible than its revenue growth. Like,
yeah, another thing with that too is that this was a company whose a lot of companies struggle to sort of scale and hit that inflection point, but these guys were seeing accelerating losses in the face of accelerating revenues, even aside from the dilution that you mentioned. That was, for me, the big thing.
It's the accelerating losses. I should have put that in my article. Maybe I'll add that in. But like, yeah, the accelerating losses, like there's absolutely no operating leverage that's happening in a beneficial way. Like as their revenue would go up, their losses would go, get worse, which is definitely not what you want to see. Again, like not what you're seeing with WiseTech. And then the other one that I really love is I definitely recommend anyone who wants to just learn a really good heuristic for spotting company you don't want to invest in. Go to Dubba's 2021, I think it was July 2021 investor update, which was a capital raising presentation that took place when they were raising capital. And slide number 15 there, they have Outlook accelerating our path to 100 million. And then there's one of those like sort of exponential graphs with a big arrow that goes up and to the right showing exponential growth. And it doesn't say, 100 million by 2023 or anything, but the graph itself has, June 2021 in blue, sort of, I guess, implying that's where they already were. And then the next 2 years, 2022 and 2023, in sort of gray with a big arrow up and to the right and sort of, I guess, like implying like it was going to 100 million by 2023 or something. And then it says the larger the company gets, the faster it grows. Now, when they would have reported their Appendix 4E, which is not your audited results, the next year, you would have thought, oh, look, it is actually growing faster. But then when it came to putting out their audited results, they didn't put out their audited results. But that was a year ago, right? Or back in 2022. They just didn't put out their audited results. They put out a thing, they're suspended from trade. We haven't put out audited results. When they finally did put out their audited results, they disclosed that, in fact, their revenue, as agreed by the auditors, was 10 million lower, a whopping 28% lower than the company had initially said in its Appendix 4E. I have never heard of a company overstating its revenue by 10 million before, right? Like sometimes an auditor might come in and say, hey guys, you need to do a write down of XYZ. So as a result of that, your statutory loss is going to be worse or whatever. And there's like a real debate to be had with the auditor about like, hey, do we have to write this off like yet, blah, blah, blah. But to see that a huge 28% reduction in the revenue, you can't get revenue right according to your own auditor, and then you can't get it sorted out in time to put out your report before going to suspension. Just incredible. And then this is the same management team. They've run it the whole time, right? The same CEO from 2015. He presides over not getting basically this report that the board, the management, the CEO puts out this report that's 10 million wrong. Okay, so that's wrong. They put out the next report. Well, it turns out they actually grew 20%, down from 25% the year before. So they're definitely not on track for their 100 million target by the time they're in FY 2023. They've done 30 million revenue, which back in 2021, they said, they sort of implied it would be 100 million. It's actually 30 million. And growth had been slowing. And they'd already been suspended from trade once when their results, when they got their revenue wrong. The collection of red flags here are just, it's like a communist military parade, like like wave. If you can't see this, you are colorblind. Anyway, so now fast forward however long, and then once again, this latest thing has come out, not because they've put their hand up, but because once again, they have not been able to get their audited accounts and they've gone into suspension. And then they've said, oh, okay, this is why we can't get our audited accounts. A couple of years ago, it was because the auditor said our revenue was $10 million less than we wanted to say it was. And this time it's because, the auditor is questioning whether we can really access this $26 million.
This time feels like they know it's a lot more serious though, I guess, right? Like they're basically saying 26 million is missing and the CEO has been stood down.
Yeah, but the CEO wasn't stood down the last time, and the guy who's now acting CEO, he has been on the board since 2011. So, as a board member, he has overseen 2 suspensions of trade, and his punishment is to become the CEO. I'm not saying the money is stealing or anything. I'm basically just saying that this company has a lot of red flags that would tell me not to invest. It's just generally speaking, I am sweating absolute bullets if a company I own shares in gets suspended from trade.
Yeah, it's not a great sign. Yeah, no.
How is that not enough to be you can't sell your shares. You're about to be stuck in here. You're just sitting there praying that the stock comes back on and then you can sell it again. There's no greater red flag than you'd be suspending from trade. This is the second time they've been suspended from trade.
Yeah. It's the most serious thing I've ever seen on the ASX that I could think of, that the 26 million's missing and the CEO has been stood down. We don't know what the connection is between those two, but it's a lot of money missing from a term deposit. How does money go missing from a term deposit?
I guess my suggestion is that after that first time the company was suspended from trade, maybe that would have been the time to do a complete clear out of management.
Yeah, it seems pretty wild. There's definitely layers of bad governance going on, right? And bad decision making. I guess circling back to the listener's original question, what does it mean for the ASX, all these good companies going? I'd say, I think the first thing is I think the ASX is just a really interesting market because it is so dominated by banks and miners. If you're a small cap investor, so it means most of the market isn't focusing on basically the good company, or they're designed to invest in miners and banks. A lot of the market isn't as focused on what could become quality companies. I don't think there's as much attention on them when they're small, but when they get big, it's kind of like what Claude was saying, is they can become extremely well valued because once they get to institutional grade size, there's not really that many other options. So stuff like WiseTech can get really, really big multiples. So I think that if you look at the way some of our largest cap companies trade, some of the big, the darlings on the ASX, the tech darlings trade at 150 times earnings. The darlings on the Magnificent Seven trade at 30 times earnings. So there's a few differences between those, blah, blah, blah. But I don't think, as Claude is saying, the beauty of the ASX is you have a market which is distracted by other types of businesses that aren't that good. You have a few good ones, but when you get them and you hold them all the way, they can become extremely well valued. And so I don't think you miss out on them being realized if they receive a big takeover offer. The ones that would concern us takeover offers maybe when they're much earlier in the journey. But I don't know. There have been some of those over the last few years, but most of them I think were companies that were either struggling and the share price had come off a lot because they were struggling to grow or had some other issue, or they're really at the top. So I'm not too worried about it, I guess, is the short answer, because I still see this crop of small companies coming through that could grow to be really large.
The other thing is I guess the game is really, and I wish I could just rip off my valuation hat more readily, because there's a lot of times when I've seen a company that's kind of that medium big company that's almost getting big, and it could be getting into that zone that you're talking about, Matt, where they get super high valuations, and I'm oh yeah, it's a bit expensive, it's a bit expensive. But if it's just on the cusp of getting into that group, I really wish I'd just ripped off, my scaredy cat hat and just bought the shares. There's one in particular that I'm not that long ago, I looked at it and I was oh, it's expensive, but I just totally see this, it's going to make it into the ASX 200. It's going to get a lot of, it's going to get that halo. And I didn't buy it because I'm worried about, I wanted it on 50 times earnings instead of 60 or something. And it's now, of course, it's had a good result. It's run up. It's 80 times earnings. And I'm and now I'm still sitting there being yeah, but I wanted on 50 times earnings. It was 50 times earnings before and I didn't get it. And I'm anchoring down to that, that really good buy I could have got. But then it's oh, well, it probably doesn't deserve to be on 80 times and it probably doesn't deserve to be on 100 times earnings. But if it continues to graduate into that class of good quality compounders with a tailwind on the ASX, then it can be on 100 times earnings.
Yeah, I think what you're getting here is the difference between relative and intrinsic valuation. So
exactly.
Yeah, on a relative basis, you're only looking at how does this compare to the other company that's on 80 or 100 times, and that can go on for a really long time. And that's how most of the market operates, frankly. Even private equity, they're mostly on relative. A lot of everything's about relative, how is this PE compared to that one. And the other approach is intrinsic valuation, where you're looking at the cash flows the business will actually generate. I like to stay in that land because in times where 2022 happens and everything gets punched, I think it's very very easy to lose your compass if you're in a relative valuation world. And like, what do you own? There's a way to play it still. You can just try and own like the cheaper thing all the way down kind of stuff. But the danger with relative valuation, it can lead you into owning a bunch of really expensive stuff right at the peak. And I personally don't like it for that reason. Like I think I would lose. I like the compass of intrinsic valuation and cash flows, but it does mean you can eventually get priced out of stuff if you're in a real mania, which is the potential downside.
I think I agree with you, Matt, but it's like I see this stuff running that I couldn't get there on intrinsic value, but I was like, but relatively it looks pretty good. And then I see it go up and I'm like, oh, I knew it. And it's like the FOMO takes hold, you know?
Yeah. That's it. That's literally it. I don't know. Try and remember. I just remember 2022. Like try and remember that February 2022 is one. It's one way that I like to think about it. It doesn't help you necessarily. Like it doesn't stop those things having a drawdown, but I think you retain like a locus of control during it. That's what.
So this is my strategy, right? Like, you know, I can't wait to like stop. Like I want to try and transition out of what I currently do so that I can be free to do things a little bit more faster and sophisticated. Like there are certain things like I just can't do while I'm focusing on giving up my 100% to the coverage at a rich life. But one of the ideas that I have done before in the past when I've been unconstrained and which I like as a strategy is I don't mind having a little bit in that sort of, I guess I would think of anything that doesn't have an intrinsic value basis as more of a trade, basically. So I would like to be in a position where I can essentially buy some of those, I think, higher quality ones that are probably not cheap intrinsically, but relatively cheap for how good they are compared to what other things are at. And then short the ones that I think have very high multiples, but probably don't really deserve that because they're lesser quality. Like, so basically go long the stuff that I think is relatively cheap and go short stuff that is relatively expensive. And because a lot of these ones kind of do move a little bit together with the flows of the market and all that kind of stuff, they can sort of match each other out a little bit. And then if you've correctly picked that this one is actually relatively cheap and that one's relatively expensive, then that's like your kind of trade. Now, I don't know how, I would not be able to do that, certainly not, you know, taking other people on the journey. I don't think I'd even be able to do that with the kind of scale of a fund. But I think it's doable on a really small scale where you can, like, in 1 minute, completely exit your position.
Yeah. The only caution I'd say is just look at like the more extreme version of what you're suggesting is kind of like value versus some of the like tech darlings.
Yeah.
Right? Like how punished people would be. So
I would never do that.
That would be the most painful. I know you wouldn't. But like, you know, just if things just keep getting worse, basically, if it keeps getting, you know, like for a long time.
The idea, what I'd like, the kind of trade that I'd kind of be thinking is actually like way more vanilla. Like, so I'm not doing this, by the way. So like nobody come breathing down my throat, please. I'm not sure anything. But, you know, the idea would be perhaps something like you'd be very long Pro Medicus, but at the set you might like match that off by being short something that's similarly highly priced, but perhaps like not such good quality. So you might choose like a couple that you think, yeah, they're just a little bit overrated or something like that. And, you know, the one that would come to mind in as that kind of pair trade would probably be WiseTech. And if you put the charts of WiseTech and Pro Medicus next to each other, you're going to see that there's not a lot of difference between them. That's the truth. So I'm not sure that trade would necessarily have done particularly well. But there are definitely been moments where, you know, basically you could be long one of the higher quality, high multiple ones, and you could be short one of the potentially slightly lower quality, high multiple ones and match it off like that. And that would be like my way of using relative valuation in a way that I would feel like you're a little bit protected from that situation where suddenly, because you don't have that intrinsic valuation support, everything starts coming down. Yeah, it's going to hurt. But in that scenario, if you're long and you've matched it off with short positions in like the similar basket, then you're probably not going to get wrecked too hard. That's the theory. Definitely not recommending that to anyone else. That's
way too spicy for me. No way.
That's the kind of thing that I like. I would want to do that. Like I want to try doing that.
I don't know if it's as slam dunk as you think. I think it'd.
I don't think it's slam dunk.
It'd be super hard, man. Like things can just be wild in the. As you said, you could have made that thesis with WiseTech and Pro Medicus, you know, a little while ago, and it's just like it's not any gains you've made in one. has been nullified by the other. And those kinds of things can last for like excruciating periods of time and with no firm rationale behind it. It's, you know what I mean? Like you might be right intellectually, but like just thoroughly wrong in practice. And if by the time you are right, you've kind of, I would have just been better just buying the stock and hodling.
Like, I mean, definitely in a bull market, you'd be better off just going long whatever you like and holding it, right?
Yeah.
But like in the ideal scenario, what you're trying to do is, and I'm not saying I can do this, by the way, like this is kind of behavior I haven't had a long stretch to that I've ever been able to do it. Like shorting is just a big no-no, essentially, if, in my view, if you're like in any kind of talking about what you're doing situation. So not short anything. But the point is that the ideal situation you're aiming for is to like be long a genuine quality basket and short the pretenders. So like an example of a pretender, it's obviously, I'm saying this with hindsight, but an example of a pretender would be Nuix or whatever it's called, NXL, you know, like when that hit the market, it was like, it's like, you know, welcome to the club. You're like the same as NetWealth and, you know, WiseTech and Altium and Xero. And it's like, yeah, another great quality software company. And it's like, just an absolute dumpster fire. Now, I didn't spot that and I wouldn't have been short it, but like that would be what I would be trying to do.
Good luck.
All right, what else do we have? Some other news that came through that I thought was interesting was Eroad's moving to dual CEOs. And I think we've talked about this before in the pod, but I just really wanted to, or just have a rant against dual CEOs, basically. So the announcement came out, was it Eroad doubles down with 2 double CEOs or something?
Double downtown. It's like 1990s game show. Like, I would bet anything it was a Gen X person who wrote that.
Bugger off. I thought it was a clever turn of phrase.
Exactly my point.
We saw Sumner made with it recently as well. And yeah, so basically 2 CEOs. I don't know. It reminds me of that meme of like, you know, these people, does it ever work? And they're like, oh no, it never does. But maybe it'll work for us. You know, like it just, I don't understand. You struggle to think of any successful dual CEOs. I'm sure there are some, like percentage wise enough to like have it still exist as a thing. But to me, it signals that they're just not willing to make the tough decision on who should be CEO. And so they lack strategic direction even before they've appointed the CEOs. And then once you appoint them, you've got 2 people who naturally are kind of battling over resources, are pulling in 2 different strategic directions. I just don't see any need for it to happen.
And possibly battling each other for supremacy. Like
100%.
I don't know who the Eroad people are. This is not a comment on them at all.
Yeah, not about them at all. And I'm sure they're both competent in their ways. But
who gets to the executive level? Like, and finally, like, you know, the people that I know that are like on that kind of path in my life, they're like very ambitious. And I think that if they were in a dual CEO role, their primary motivation would be to make sure that they're like supreme over the other CEO. Not like that would be the first goal. You know, you don't get to CEO without being very ambitious. And like, they're going to be like, oh, well, now I'm co-CEO. That's the cap of my ambition. Just happy where I am now, guys. Like, I don't think so.
Yeah, there's so much opportunity for problems and bias. Like anything that goes wrong, you're trying to shift blame to the other CEO. Like I just see a lot of problems with it. What were you going to say?
One example that comes to mind, I think we've mentioned it before, is Cobram Estates. So they grow olive groves. Basically, it's not the most sexy of business, but they seem to be doing okay. There's a rationale there of one is sort of finance and operations, and one is production and growing. So there's a clear delineation. But trying to get to the but quickly, you kind of think that's more of a joint COO, or just got different unit heads kind of thing. It's the lack of the overall strategic direction. Now, maybe in some instances, if there's enough sort of executive director influence at the board level, and it's the board that's very clear in making those decisions, and they're delegating to joint CEOs, maybe I'm trying to make it kind of work. Yeah. But
the reason you have a hierarchy is because you need someone where the buck stops.
Yeah. Yeah,
I guess like that was the point I was trying to make with Dubber. Like, how is it the buck stops at the CFO? Like, no, when something bad happens, the buck goes all the way to the CEO. Like, it should.
Even if they weren't aware of problems, I think it kind of comes with the territory. It's like that. This is the burden that is on you as the leader, and
exactly.
That's fine, but that comes with the territory.
You're getting paid the most invariably, like except in rare circumstances, you're paid the most and you are going to get the glory if it succeeds.
Yep.
And you're supposed to take the hit if it doesn't.
You're the Roman architect that has to stand under the arch as the keystone is put into place, right?
Yeah, exactly. And but the optimum result has got to be, and this is why it's used so often, you have a CEO. They are the leader of, they make the final decision on everything. And then they go around telling everyone, hey, we have a really flat structure, guys. That is what you want.
Yep.
Yeah.
But it works, right? If everyone has access to the CEO, like that's what I mean by the flat structure. If you do have that, what it means is that the level below the CEO doesn't have such a concentration of power, which is good because it's that secondary level that are most likely to be butting heads with each other. If everyone has direct access to the CEO, then it concentrates power in one person, which also should and must concentrate responsibility.
Mm-hmm. Yeah. Yeah. And just to what you're saying before, Andrew, where we're like one's more focused on operations and finance, that's a CFO and COO.
Yeah.
You don't need to have two CEOs. Yeah. I think that can work really well, by the way, like a really strong COO and like a visionary CEO founder. Like that's kind of SpaceX with Elon Musk, right? Where they've got like Elon as a visionary and then this really strong COO that like keeps them grounded. And
Dicker Data is another great example of that structure, right? So they have CEO David Dicker, and then the CFO and the COO have, as I understand it, they've been running that company for a long time now and doing a good job. And but then having, I guess I'd be very surprised if there was any butting heads going on really between that team. Like it's like they're working for David Dicker. He's going to be like the final decision maker. I'm sure that any disagreement on strategy between the CFO and the CEO is very simply resolved. David, what do you want to do?
Yeah. Yeah. I mean, I think it can work. There'll be some examples. I think if you have the exact right people, probably co-founders, I think that kind of solves the ownership issue, or someone who has a lot of ownership, then I think it can. But every time I've seen it on the ASX, I can't think of an example where it worked well. And sometimes it went really badly. So yeah, that's my end rant.
But even the co-founders, they need to they need to manage a friendship, right, as well.
They do, yeah.
I think that, I'm not saying anything, but if you live in the Sydney's eastern suburbs, there's some pretty prominent co-founders there, and it must be a big effort for them to manage their relationship when they're running a huge software company together.
Yeah, 100%. Yeah, co-founders figuring out different roles within it, both being founder, I think that can work really well, and that's where you have the classic kind of technical and sales pairing, or two different mindsets kind of pairing. But yeah, maybe not at ASX level. What else we got, guys? We had one other email come through actually that we could chat through. Hi guys, another stock suggestion. Cleanspace Technology, small nano cap, market cap $26 million. Shares some personnel DNA with ResMed, with founder Dan Cow, starting the company in 2009, having been at ResMed for 8 years prior. Board looks pretty experienced. Product looks great, albeit expensive. Stock listed in 2021 at the height of COVID has come down a long way and started to bounce around 35 cents. Yeah, shares a few metrics, price to sales of about 2.33 at the time that this came through. The reviews on Glassdoor are good. Had won a design award. Wondering what you guys think. Seems like a great product with a long runway ahead. What do you guys looked at Cleanspace before?
I definitely think it's a great product. And you're not really seeing, that I could see when I had a quick look around, necessarily too much competition at that super high level. So what Cleanspace do is they essentially have the best quality respirator kind of masks. So this is probably the kind of thing that the hospitals should be supplying nurses that are in COVID wards, for example. It would actually genuinely stop them getting sick from it. However, the problem is, I think when it floated, there was a lot of hope and expectation that governments would go that way, and they would basically say, look, it's not acceptable to us that, healthcare workers who are tasked with looking after someone who's, in hospital with COVID, it's not acceptable that they get COVID, give it to their kids, and all of the flow and effects. Of course, what we decided apparently is that no, we're going to have forced infection of a whole lot of people, from nurses to school children. And this policy of forced infection essentially means that there's no, they don't need to pay for the Cleanspace masks. Now, that leaves Cleanspace basically selling their products to industries that have active unions that care, and in many dangerous jobs where there's some sort of, aerosol risk. So people that are on building sites or in factories where there's gases that could hurt them, that's who Cleanspace is selling to. Because bizarrely, whilst we decide, essentially for some reason it's fine for, healthcare workers to get sick at work, but it's not fine for coal miners to get sick at work. That is showing you. We were talking about unions the other day. That's unions, right? That's because the coal miners have had a long history of unions that are like, nah, we don't want to die of black lung. That's who they sell to. And I think price to sales is not the correct metric to look at this very small company that has got a very small niche. Unfortunately, it should be a large niche. It should be a big burgeoning market, but it's not. And part of the reason is it's just like they're so much more expensive than the disposable respirators, right? So, the disposable respirators, they going to protect people a lot of the time, not 100%, but 98%. So that's what they're using. And I don't think that's going to change. Like, in fact, the upside in protecting healthcare workers is probably just using those disposable N95s more frequently. They're not even at that stage. So you can, I think, safely for the foreseeable future, completely forget about all of that upside that people were excited about, and which is what bid up the Cleanspace share price in that key pandemic time. I guess like vaccines had a big change in it, right? Like their big sales were pre-vaccines for COVID as well. So people were more likely to be like, no, we want 100% protection, not 99% protection or whatever. So now I don't think we're ever going to be using these things realistically on a large scale to protect from disease, which means you've just got the same old niche, which is essentially relying on regulatorily induced demand, where there's some kind of risky role that demands that somebody has this absolutely 100% protection. And it will not do that they have 99% protection. So it's a very, very small niche. And I don't think that there are any that I can see any like growth, particularly big growth drivers in that niche. So I wouldn't say that it necessarily, surprisingly, I would not say that it has like a demand tailwind there. Now, there might be specific situations or markets in which there is a demand tailwind that I don't know about. So I wouldn't take that as gospel by any means. But what I would say is, yeah, this is definitely not a price to sales business. It's a loss-making business. It's subscale. It needs to be a profitable business. Like, it's not close to that. It has a loss of, an EBITDA loss of 2.6 million and a loss before income tax of $3 million for the last half on a revenue of just 7.3. So it's extremely subscale. You would sort of say, well, this company should not even be listed because it's not really big enough to justify the listing costs and the costs of being listed. And obviously, the listing was taking advantage of this huge spike in sales they had that was like a point in time. So yeah, for that reason, I totally think it's a real business with a real product, but it's not big enough business to have even really justified being listed, essentially. So what can you do? It's a good little guy, but it's just, it's not, you can't carry the costs of being listed and all of that. A huge board, you can check in the remuneration reports how much the board receives. But I certainly remember when I did, which was a while ago now, so it could be out of date. But when I looked at this, a while back, I was like, oh wow, this thing's just carrying a huge board, but it has like minimal growth prospects. So there's no way out. I'm just looking at it now. Non-exec directives. They're paying, it's gone down a bit actually. So it was 400 or 386K. And now the non-executive directors are down to 306K. And then in terms of the executives, you have another 1.5 million on that. So you're pretty much on the board and executives, you're paying just under 2 million. You'd have to take, even if you took out the entire board and paid one executive 500K, you'd still be losing money at the current scale. So yeah, just those listing costs probably have to go. So maybe this is probably going to be a company that's like lumpy or whatever. So there might be a time when it looks a little bit better. It could be one of those ones where, the sales are good, the profit goes up. But I have made my mistake recently about buying, into something that even was profitable, but it relies on, sales. And if they don't hit those orders, then suddenly it becomes unprofitable, and massively so. And that's what happened to Cleanspace. And yeah, I just think that unless there's very predictable demand for this kind of thing, you need to have it so reliably profitable that even in a bad year, it remains profitable. And clearly Cleanspace is not in that zone.
Yeah, I mean, the share price is down like 95% from when it listed, but the revenue is also down, as at least at FY23. It looks like it's coming back up a bit, but that was down 76% in 2 years. Yeah, just kind of shows it's not just that it was overhyped as in like share price, it was just massively over earning during that period. And for me, it feels like quite a hard business to grow out of. As you're kind of saying, Claude, it's kind of saddled with all of the costs of being a bigger company from when it IPO'd, but it just feels like a really tough business to grow out of, winning over people to a more expensive upfront solution. It's like a hard sell, basically, particularly when it's those people aren't the decision makers, the people who benefit the most from it. So that requires just regulation, which, again, if there's not that many players, it's like a very expensive regulation that you're putting in. So yeah, I would give it a wide berth. But did you have any thoughts on this one, Andrew?
I was just thinking, I know I've made this comment before, but it strikes me again as the kind of company that the investment bankers can all high five themselves with. It was an incredibly, phenomenally successful listing, right? Like
Andrew's like victory lap for the people who made off with the millions.
Oh, I'm on
the bright side, those investment bankers made a lot of money.
I'm just you've got to understand the incentives that are at play here, and that it was completely opportunistically timed off the back of, a very big spike in sales. They're desperately trying to sort of right-size the business. Yeah, they've had some good growth. They're now saying that, again, with costs cut, that they should be cash flow break even this year. I kind of get it. But at the same time, it's just like another example of why you have to be careful with companies that are new to the market and being wary and extrapolating sort of past trends. But, I'm not I wouldn't be super confident and say, oh, this is a disaster. I'd stay a mile away from it. It's usually at points of peak pessimism that are interesting to me. There are often a lot of false positives in that, like a lot, but they're interesting. And I could see there is usually good reward for those that can sort of see past a lot of the previous missteps and say, well, there is a nugget of a business here and it's not a terrible one and it's got a future. I don't think that, because I haven't done the work to reach that conclusion. But yeah, at best for me, it would be on a watch list. And I guess the signpost that I would be looking for here is some kind of sustainability in sales growth, that they're able to flex off a reduced and hopefully not going to increase any more cost base, would be some pretty interesting signal in that. I know there's a what's it called, consumables component to the product as well, so maybe that gives them something. I can see why the interest is. I can see why it might grab your attention if you like to sort of look for things that are out of favor, but it's still too early to sort of say that, yes, they've turned any corner, at least with my very peripheral look.
Yeah, I guess I just say, like, looking at the most recent half, revenue is up 27%. They're still burning, they're still losing money, but revenue is up and the burn decreased. So I do think it's the right area to be looking in, as Andrew's saying. Like, it probably hasn't turned enough for me given the economics of the business. But if it keeps growing at 27%, if you have a view on why that will, then yeah, obviously it can.
That's the crux of it right there. Why will it do that? And maybe it can. It seems, just looking at their presentation, that there's some hope on new products and moving into new geographies. And obviously there's massive potential with either of those things. But that's kind of the growth driver of most companies. We'll invent something new and we'll go somewhere else and sell our existing stuff, and it's far from guaranteed. But if some of those moves were made and then traction was gained, yeah. But yeah, I'm with you guys. Not now.
Why will it keep growing is one of the biggest questions I think that I try and answer. And it sounds really obvious, but it's very easy, especially in small and micro cap companies, for there to be a period of growth and that just stops. We've talked a few. I won't go into them all now because we're probably wrapping up, but it's very easy. I
don't want to talk about my portfolio right now.
It's very easy for that growth to stop. And you, as an outsider, don't know why. And that's, as a growth investor, the worst thing that can happen. So having a really clear idea.
It's so hard, right? Because, well, you're so right. Because the thing that always messes with my brain is that even the companies that are ultimately going to succeed have the stumbles, have the stagnant periods, have the disappointing quarters. Like, it's so normal. And it's that teasing apart of it. Now, if you're going to be the kind of, especially if you're a growth investor and you're looking for the long-term multi-baggers, if you're sort of hunting across the ASX, if you jump at every shadow, you catch a zero of these opportunities. And you point to me an example, and go with our favorite, Pro Medicus. I mean, it had some underwhelming periods in there. It just does. And so that's the tension that I really, and I am way too forgiving. I know that's a weakness of mine, but do I have a knee-jerk reaction at everything that's negative? Or do I understand that even when I'm winning, I'm going to have periods where I'm losing? And it's just, I have, the rewards come to those who are sort of able to sort of withstand those periods and potentially even add to it if the conviction's you've got any reason to hold the conviction. But if anyone's got any easy answers on how they navigate that, I'm all ears.
Yeah, I don't think there are any, unfortunately. Or fortunately, keeps the game interesting.
Yeah, true.
All right, should we wrap up? Claude, did you want to do a round of gratitude, an attitude of gratitude?
Yeah, why not? Andrew, you want to go first, mate?
God, I forgot all about it. My mind's just racing, and I'm desperately looking at. I had the AFR open and scrolling down that. It's like, there's no good news.
No, it's not good news. It's like what made you smile this week?
What made me smile? We had I don't want to out myself too much because it's still sort of all happening, but we had another look at the house that we're very lucky
very
to
cool.
own.
Hurrah.
Awesome.
Oh, it's so beautiful, man. It's just it's humble, but it's exactly what we kind of need, and it's a little bit out of the way, and it's going to be a very different lifestyle to sort of West Sydney.
Awesome.
I'm grateful for a bit of nature.
Mate,
It's going to be
you are
killing
killing
Fantastic.
it. You're hitting it out of the park with this gratitude.
Yeah.
There you go.
And I'll take inspiration from that. We bought like an old 1960s house like 9 months ago now, and it's been a really long and expensive process to renovate it. And we're getting close to the end of that. It's like looking really good. I can't wait. It has a massive tree. I'm gonna finally get one step closer to my treehouse office that I've been working towards for like
my whole life since I was 7 years
so
old.
long, man. Yeah, exactly. You got to hold on to the dream. That's what I say.
Yeah, nice. I'm grateful to live in Australia. I think we are literally one of the best, if not the best, country to live in. There's so much opportunity here.
That's a
Incredible
New
system
Zealander
that
saying it, guys. Ooh.
Yeah, I said almost the best. No. I mean, I am living here, so there you go. That's some indication. Yeah, I think it's an incredible country to live in, and I think we can take it for granted way too easily. I think it's kind of good that we aren't always satisfied because we keep pushing for more and things to be better. But it's also, if you look around the world, really great place to be. So that'll be my one.
Nice.
All right. If you have any thoughts, hit us up with questions. Hit us up on Twitter @BabyGiantsPod. Until next time, thanks for listening.
Thanks, everyone.
Bye.